understanding the risk unit and how to use it. The risk unit is the most important concept to learn for every new trader. Yet most start and fail their career without ever considering it. And it 100% is one of the main reasons they fail. Many like to shorten risk unit by saying RR or RU, but we like to simply call it R. R for risk, because it's all about managing your risk. Your risk is what you are willing to lose on each trade. May that be $10, $50, or $100. The most important thing is, once you've found the risk that you are most comfortable with, you will never change it. The only exception being when your account has risen high enough that you can set a higher risk and repeat the process. This amount should ideally be around 1 to 2% of your account. At the same time, your risk is also your reward. If you are risking $100, then your trade should also reward you with a minimum of $100. At first, you might think, but this all sounds very personal. Why should the market act according to this personal requirements that I made for myself? But it is not. These kind of scalps happen dozens of times every day, and many times they do it with 100% precision. Not stopping 1 cent before and not exceeding 1 cent above before going quickly back to the break-even point, or even the stop-loss. So once you know where your entry point and where your stop-loss is, you automatically know where your minimum target is. If your stop-loss is 10 cents below the entry price, your target is 10 cents above that. This is 1R. Fortunately, most brokers are providing us with a handy tool which we can put on our charts, so we don't always have to do the math. They go either by the name long position or short position or risk-reward ratio, but I like to call it simply the risk grid. It is portrayed by the symbol of 3 lines, with 3 circles on the left side and 1 circle center right. These circles are the points from which you can adjust its extensions and position. Keep in mind that when executing your trade, even with a stop limit order, things can get slippy, and way more so if you hop in manually. So your profit or your loss may not always 100% reflect what you see on the chart. For example, you might only be able to profit $98 while a loss takes $102 from you, even though your risk is a strict $100. If you find yourself in such a situation, it's all about your psyche. Split your mind between the technical trade you planned out on the chart and the practical trade you ended up taking. And always rely on the technical for when to exit. Now, let's apply this to the placing of an order. Since a stop limit order will always be faster than you, it is recommended to use that if you aren't already. The first 2 fields we want to fill out are the limit price and the stop loss price. Once we have that, we can go on to placing the shares we want to buy or money we put into the position. Increase or reduce the shares until the stop loss offset shows your chosen risk in dollars. Setting a take profit price or leaving it blank is up to you and your strategy. As mentioned at the beginning of the video, many trades can completely reverse after 1R is hit. In that case, it would be safer to have a hard exit point set. Letting a trade that already counts as a winner turn into a loser is way more frustrating than missing out on potential runners. So, for a quick summary of everything we learned today, find a risk that you are comfortable with. Have it be 1 to 2% of your total account size and never change it. Think about entry and stop-loss prices first and let them show you where your targets are, either by doing the math, using the grid, or in the window where you place your order. Don't put the same amount of money on every trade, but adjust your money so that you get the same amount of risk for every trade. I can assure you that if you apply everything this video explained, your results will get much better. Never again will one trade wipe out all the profits from the 10 trades before. Thank you so much for listening and thank yourself for using this information.